Hello everybody, welcome back to my YouTube channel. This video we are going to talk about the only trading strategy that you will ever need. And of course this video is not a financial advice. This is not a recommendation to buy or sell any stocks, securities. This is all done for the information and education purposes only. Please consult your own financial advisor before making any investing or trading decisions. So in this video, we are going to talk about the only trading strategy that you will ever need. This is some basic price action principles, some basic price action rules that you can follow and trade on any time frame, any chart, crypto, futures, stocks, whatever you want. You can trade it with only this trading strategy. You don't need anything else. Of course, you can build on it. You can build up on this trading strategy, and that's what I really want you guys to do, is to learn the basics and then build up on the concepts, build up on the strategy and develop your own trading model that you can rely on, that you can believe in and be confident in. And the true confidence really will come in after you backtested this strategy, after you backtested your model, and then you will have enough confidence to go within the live funds. But I truly believe that this is the only trading strategy that you will ever need. So without further ado, let's dive right into the strategy. And the first thing I want to point out is the nature of the market, how the market moves. And really, there's only two ways that market moves. It's consolidation, which is stuck in a range, up and down chop that a lot of people don't like. But in fact, in that consolidation, we can find clues for the new expansion, because each expansion starts with consolidation. So really, there's only two ways that market moves: consolidation and expansion. And before all of the ICT guys, all of the fanboys getting triggered, I know this is the price delivery algorithm that ICT has put out on his YouTube channel, and he talks about it: consolidation, expansion. So it always starts with consolidation and goes into the expansion. And then after the expansion, we can anticipate retracement or reversal. So if retracement fails, it becomes a reversal. But I want to point out that retracement and reversal, it's an expansion. It's the same thing as an expansion. So if we have expansion up, retracement would be expansion down, or reversal would be expansion down. So it is, again, reversal and retracement, it's the same as an expansion. So that's why I'm just going to refer to the market as consolidation or expansion. These are the two market profiles that repeat over and over and over again. And as traders, we can capitalize these moves. The easiest ones to capitalize is expansion, because we can get in at the lows, get out at the highs. It's easy to see and it's easy to follow. So this brings me to the best strategy there is. Simple way to put it: we want to buy low and we want to sell high. And I know, it's such a cliche, but like with most cliches, they end up being true. So if you think about it in a simple way, if we can just buy low and sell high, we will be profitable. So in a bullish trend, we want to buy low and we want to sell high. We want to buy low and we want to sell high. We want to buy low and we want to sell high. Now, since this low that created the new high has been broken, this trend becomes bearish. And now we can do the same thing on the bearish trend. Sell high, buy low. Sell high, buy low. Sell high. And now we have another shift over here. We have another market structure shift that's going back up. And we can resume buy low, sell high. Buy low, sell high. And it's very easy way to understand the market, but yet everybody makes it so complicated. Everybody has all these strategies. Well, you buy low, then you buy lower, or you hold on until it bounces, blah, blah, blah. It doesn't matter. If you can just buy low and sell high, you will be profitable. And of course, you have to risk less than you make, or at least 1-to-1 risk to reward. But this is the first principle and concept I want you to understand, is that if you can just buy low and sell high, or do not buy high, right, and do not sell low, this alone will make you profitable if you can stick to the rules. And here in this video, I'm going to give you some rules. So a lot of people get tripped up on the wrong market structure shift. Let's say we see this trend going up and down, and a lot of people would start placing their stop losses below the last lows, right? Below the last lows. Let's see, they get stopped out over here. They then will place stops below here. Starts going up, they got stopped out again. But the last low that created the high is the most important low. This low is going to be protected. This low is going to have the strongest support. This low is going to be a deciding factor if we are switching bullish or bearish. So if we can find a support here, right, and bounce out and make a new high, then this low will become an important low because this low made a new high. So what happened here in this scenario that I drew out, we tried to make a new high, but we couldn't. We failed. So this becomes a swing failure, and now we can anticipate a break of the structure. But we don't anticipate a break of the structure below this low. We want to see a sell-off all the way below this low, and the candle closure below this low will confirm that we have a change of character, that we have a break of structure. So now after this low is established as the new low, we want to anticipate a retracement for the short down. So if you can just do this, if you can wait until the last low that created the high is broken, you wait for that break, candle closure below the level, and then you anticipate a run up, and then here you look for the reversal pattern on the lower time frames to get in for the short. This is the simplest way of explaining this whole strategy, which is market structure. If you can just follow market structure, you can trade this on any time frame. 1 minute, 5 minute, 3 minute, 15 minute, 1 hour, 4 hour, daily, monthly, weekly, 5 seconds. You can find opportunity every single day on any time frame. You can find multiple opportunities on a given time frame. The lower the time frame is, the more opportunities you will have. So this is the first rule for this strategy, is we want to identify a higher time frame order flow. And how can we get in sync with the order flow? We want to track the last low that created the high and the last high that created the low. Because just like in this case, the last high over here that created this low has been broken. And now we want to anticipate a retracement back in the area. Maybe there's some PD arrays here that we can get in confluence with. And then we want to see a reversal pattern on the lower time frames right in this zone. It's going to be looking like this, right? The same pattern on the lower time frame, which we see on a higher time frame. And we want to anticipate it in this area on a pullback after the manipulation happened. This is the manipulation. Up, down, up. Boom. And then here we want to enter up. So this is what I want you to keep in mind. And this is where all the framework will be coming from. So now that we understand this concept, where is the best area to get in? Well, of course, the best area to get in is after the break of structure on this pullback over here. So every time we have break of structure, we look for the PD arrays. We look for some kind of confluence. It could be only 50% of this area here, of this range. Most of the time, price will come up to the 50% of this whole range over here. And then align itself with some PD array that will give you a short. And again, we want to anticipate this pattern playing out on the lower time frame, and we only going to enter on this pullback over here on the lower time frame, because that will give us the highest probability trade, and we're going to place our stop loss about here. So we enter here, stop loss, and look at this RR. This is 1 to 5, 1 to 10. This is a very low risk trade, stop loss above, because we are anticipating a lower time frame entry. We're anticipating a lower time frame entry all the time. So we identify a break of structure, wait for the pullback into at least 50% of the area, and on the lower time frame, we look for the same setup as here in higher time frame, because time is fractal, and the same pattern you see on the higher time frame repeats in the lower time frame. So the pattern that I'm talking about is this. It's a basic reversal pattern that everybody's looking at every single day, and it's in front of your eyes every single day, and it happens on every single time frame. Every time there is a reversal, it's this pattern right here. And if you don't believe me, go back in the charts and I will show you example too. The same pattern plays out on every single time frame. And if you can't find it on 1 minute time frame, and you say, oh, look at this, this pattern is different. If you look closer in the lower time frame below 1 minute, maybe on 10-second chart, it will be the same pattern. But the point here is that we want to anticipate, we want to see this pattern, and we enter on the pullback after the manipulation. So we have a low, we have a high, the low gets rand, and then the high gets rand. That's manipulation. And after this manipulation, we can have a pullback back to the 50% of this area, right? This high, this manipulation, back to the 50% of this manipulation. This is the highest odds entry, and we can take TP1 here, very conservative, but most likely it will keep going higher because it's a reversal, and depends where we are on the high time frame trend, we can look for the targets there. The same way for this reversal, the same way. We have a high, we have a low, high gets rand, and then low gets rand. This is a manipulation, and we want to enter on the retracement on the at least 50% back to the area. And that's where you will find a confluence in PD arrays. Usually there is a volume imbalance. Usually there is some kind of price action where the equal highs are, and you will be able to see this happening in real time on every single time frame. And like I said, you're not going to believe me until you see it. So you need to go into your charts and backtest this and look for this pattern on a high time frame and on a lower time frame. So back to the nature of the market, this is how market moves. So let's say we identify a trend on the 60-minute time frame, an hourly time frame. So the best trades gonna be, of course, on these retracements. And if we can just buy here and sell here, we would be making a lot of money. And of course, we can trade every move too. So let's say there was a sell here, we took it back into the 50% of that previous area there. Then again, we had a buy here, and we could have taken outside to external liquidity. So here what's happening is we sell with a target of internal liquidity, and then we buy with a target of external liquidity, something to the left here. Or also I will show you Dexter's standard deviations, and you will be able to project the manipulation that happened here and target the expansion. So this is what we see on 60 minute. Not a lot of information, right? It's hard to say if this is going to reverse or not. But then if we zoom in into the 1 minute, and again, this could be 5 minute, you know, this could be 10 minute, the 60 minute and 10 minute, this could be 5 minute and 1 minute. But the point is that we want to identify high time frame trend and get on the right side of the market. So of course we can short this, just like I was seeing here after this pattern played out, right? High, low, high gets ran, low gets ran, enter on pullback. This is a small pullback here, but we got to keep in mind that this trade is only going for internal liquidity, and we should not anticipate a break of this because we are in a bullish trend on the higher time frame. So now we identified there was an important low here. There was maybe some imbalance here that we came and tap in on the 1 minute. And we don't enter based of this imbalance, right? You don't want to enter because you don't know, this could just keep easily going lower. We don't know. So that's why we want to wait for the pattern to emerge. So we got a low, we got a high, we got a lower low, we got a break of the high that made lower low, and we want to enter where? On the pullback. And then we have the same thing here, continuation, and enter on the pullback. So we don't just buy blindly this low. We zoom in into the 1 minute and we want to see a pattern play out. And like I said, you can short this, but you want to keep in mind that we going to internal liquidity because of the higher time frame trend. And also in a bullish trend, the short setups are not going to be yielding as much profits as bullish setups. So if you want to have even better odds of having a winning trade, you want to align yourself with the high time frame order flow and only buy in a bullish trend and only sell in a bearish trend. That strategy will give you the biggest RR. And you can scalp these moves down if you can read the market that well. If you're in sync, if you're in the zone, you can scalp these moves. You can scalp it down and then see prices bouncing around your PD arrays, close the short, and anticipate this pattern. And when this emerges, then we going higher. And again, we taking outside, external. This could be take profit one, but if it's a bullish trend, you know it's going higher. So you anticipate it's going higher. So you have confidence in holding this. And then maybe you can get out when you see this pattern on top. Maybe you don't even get out until you see this pattern. Maybe there's some PD array. You can take profit and wait for another pullback and another pattern down here. Or you can scalp this move down, right? And then wait for this pattern. And the same thing, we don't enter just because price traded here. We want to see this pattern play out. Low, high, lower low, higher high, pullback. This is the pattern we want to see, and that's where we enter. So here's another visualization of the trend. As you can see, this is a higher time frame trend, this gray line. We got higher time frame trend, and on each swing point, you will be able to see this type of pattern. And this is all what you need to focus on. At least in my opinion. It helped me tremendously in my trading. I like the idea of less is more. There is a lot of trading tactics. There's a lot of trading strategies, models, blah, blah, blah. This is it, okay? You don't need anything else. You can build up on this, but really you don't need anything else besides this, because logic is always going to be superior to any pattern, to any trading model. If logically it makes sense to buy here because it's a pullback on a high time frame trend, doesn't matter what pattern you have, doesn't matter what's on the chart, doesn't matter what trading model you have, if it's pulling back and printing this pattern over here, you can have a high probability trade that is going higher. And there's traders all the way here that still trying to short, right? And they shorting here and see maybe price comes back into this area again and rejects it a little bit, and they shorting here, not realizing that the high time frame trend is bullish. So we can be buyer over here, buyer over here, buyer over here, and look what happens now. Boom. Our stop loss is right here. If you want a purely mechanical system and you just want to trail the stop loss and capture the most meat of the trend, you want to trail your stop loss right below the last low that created the high. Why I didn't trail the stop loss below here? Because this low didn't create the new high. So if this low couldn't break a high, this becomes a weak low, and we target this low. And if we go in below and closing below this low that created the actual high, it's game over. It's market structure break. We assuming the trend is bearish now, and we wait for retracement, and we can enter on this retracement. We can be seller here, and wait a second, whoop, we have another break of structure because this high created this low, and now it's broken, and now we can anticipate pullback and enter bullish trend, right? This is how I see the market now. I can see this on every single time frame. And once you see it, you can't unsee it. And of course, there are going to be nuances within the price action. There's going to be ranges. There's going to be, big push up and then chop in the range. And we go up, we go down, we go up, we go down. But these ranges, consolidations, will tell you the story. And also those ranges you can trade, right? You can trade the range. Buy low, sell high. It's all you need. You can trade this on the lower time frames. And if it's a range on the 5 minute, it's probably going to be some tradable things on 1 minute or even lower. If it's a range on 1 minute, the 10-second will have these moves up and down. So there's opportunities every single day. Do not let anybody to tell you that you can't trade Monday, or you can't trade the news day. You can't trade this and you can't trade that. You can trade it, but there are different environments in the market. Sometimes there's a lot of volume. There is a lot of big participation from the retail crowd. There is a lot of people watch the news and the new bull market and all, and they start buying and buying and buying. Sometimes there is a lot of volatility in the market. Volume and volatility is not really the same thing. And each of them are bringing different characteristics and different nuances to the price action. It's still going to reverse like this. But, before it reverses, it might chop a little bit, might go up a little bit, didn't close above the high, goes back down. Sometimes we have some really choppy price action. There's no such a thing as bad price action. Sometimes it's more challenging, and sometimes you get a clean day. Sometimes you get a clean trend day, and you just buy low and you hold it, and you keep trailing your stop loss below the last low that created the high, and you ended up catching the whole move up. There's easy days like that. There are different environments to the market. But the main point is you can trade it. You can trade anything. And, if ICT says do not trade FOMC day, he's only saying it because you are not experienced. Because you haven't gone through trading 50 FOMC days that what can you actually expect. You know that you shouldn't maybe trade it right before it because there's going to be a big spike, because there's volatility going. You can still trade it, but it's going to be more difficult for you as inexperienced trader who haven't seen this play out all the time, over and over and over. And I personally haven't. I have started trading from 2020. I never paid attention to this stuff until recently, until maybe like a month ago. And I always knew about it. I always knew, blah, 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 market structure break, blah, 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 this and that. I've been trading since 2020, the retail concepts. And then I got introduced to ICT in 2022 in September. And now I have been getting into standard deviations with Dexter, and also watching Dave on YouTube and his masterclass about market structure. And this video, I'm putting it all together. Once you understand this, I believe truly that there's nothing else you need, and you can be trading this forever. So here's an example what might happen in the market. And as you can see, we have higher highs, higher lows, bullish trend. Now we want to know when to buy this bullish trend. So as I was saying, in a trend, the price usually comes back at least to the 50%, right? At least to the 50% of the previous area. So what is the previous area? The previous area is this price action over here, this box over here. So we made this high, and then we had a pullback. So after the pullback is finished, we had the reversal, the same pattern that we like to see all over the market. After this move up happened, market printed a high, higher high, closed above the previous high. So now this low becomes protected. So we want to anticipate price coming back to the previous area of price action, previous zone, whatever you want to call it. And it's right here. It's the previous area where it's not mitigated, meaning the price broke out, right? Made a new high, and before it's going to make a new high, it's going to have a retracement, because market doesn't move in a straight line up or down. It has retracement. So where is going to retrace? It's going to retrace back to the previous area of price action. That's where the most volume is. That's where the most trading is. So if we, let's say, miss this move, no problem. We can anticipate the retracement. And if we don't get this retracement, right, and we just bounce maybe here, still tapping into the area. If we don't get retracement to 50%, that area becomes unmitigated. So if the area is unmitigated, we can expect in the future a comeback to that area. A price action will be mitigating that area. And in a lot of cases, there's going to be some volume imbalances. This is a sweep of the low, so the turtle soup here. But we don't want to enter blindly on this 50% because we don't know if price going to reverse here. We don't know, because we truly don't know if this is going to hold. Could easily go and all the way up to here, still holding the low, and then reverse. We don't know. So we want to wait for our reversal pattern. And what is the reversal pattern? Is this. And that's what we see happening here. So price broke out, and now there is this unmitigated area, right? Price broke out of this box over here and never came back to test 50%. So now that becomes unmitigated area, and we can anticipate a pullback, which also could have resulted in the liquidity grab, liquidity purge. Maybe there is an imbalance. Most likely there is. Taps in and goes. And probably on the seconds chart or whatever on lower time frame, you will see the same pattern that's played out here right at this low. Because time is fractal, and what you see on the high time frame, that's what you can expect on the lower time frame. So now I'm going to give you a trading checklist. How can we actually capitalize on these moves? This is where I'm going to introduce Dexter's standard deviations. And as you can see over here, this is what it is. It's right here. And all it is, what we're doing here is we're measuring manipulation swing. Okay? That's what you want to do. So you see this manipulation, right? The pattern, the reversal pattern we like to see. We want to measure this swing over here and project targets. So if we do that, we can anticipate a retracement at minus 1.5 and minus 1. This would be an opportunity to get in, and it might not retrace all the way back down. It might retrace maybe over here. I don't know. You don't know. That's what the rules are. We want to anticipate a retracement inside this zone. Once we get it, get in, and we want to take profit. The first take profit is going to be at minus 2.5, minus 2, which, as you can see, aligns with this high over here. So we can take the profits near the high in this zone. And then this zone in itself should give another retracement. and should gives another retracement here, and then we go for the final target of -4, -3.5. That usually takes us out external range liquidity and beyond. So these two provide internal range liquidity purges, right? We retracement here, comes down, purges liquidity, bounces up, comes back down. There's probably a liquidity, some low or some imbalance here that price taps into and finally breaks out, right? The same here, 2.5, the same thing. It comes down and taps into some kind of liquidity and goes up higher. So based on this, where can we enter? The best entry is here, over here, right? This low and this low. These are the best entries on this chart. So again, we don't just blindly buy on the touch of this 50% zone. We wait for this pattern to form and then we buy on this retracements, right? And as you can see, the price retraced from here down back to unmitigated area. So that's the logic that you want to follow when you're trading this. So the simple trading checklist: identify high time frame trend. So if the 60-minute looks like this, it's bullish, and we want to buy the pullbacks. Wait for retracement to 50%. There it is. We waited for a retracement to 50%. On lower time frame, anticipate a reversal pattern at 50%. So once the price reached 50%, we zoom in into lower time frame and we anticipate this pattern, right? Enter on the lower time frame, stop loss below the manipulation. This is the manipulation. So there is the manipulation. We have a low, we have a high, we broke the low, we broke the high. So this swing down, that the last swing down that, purges liquidity over here, taps into the imbalance and comes back up. This swing over here, this is what you want to measure. For these projections, for the Dexter's projections, Dexter's standard deviations, you want to measure this swing over here. And sometimes you can measure wicks, sometimes you can measure bodies. The bodies will give you more conservative targets, but you can do both. And there is no right or wrong way. You can do both, right? We have the stop loss over here. We have target 1, which is -2, -2.5. Target 2, -3.5, -4. Simple strategy. So again, I want to point out this thing over here is that we want to identify a high time frame trend and zoom in into lower time frame to anticipate a reversal pattern and enter a trade on the retest of that area. So now I'm going to show you some examples from the Nasdaq. And since we've been in the new bull market, a lot of people now expecting, including me, expecting a bearish reversal, and we've been going, up, up, up. But a lot of people would say right now that we are bearish. And on the 4-hour, we're still not bearish because we haven't broke the low that made a new high, right? This low is responsible for making this high. So until we break this low, we're not going to flip bearish. We could be bouncing from this unmitigated area that I drew out here. See, this area is unmitigated. We have the pattern, right? We have a low, we have a lower low, we'll have a high high, pull back into this area. It pulled back into this area, 50%, but it didn't pull back into this area, right? It didn't pull back into this 50%, into this unmitigated area. We have the same thing here. High, low, higher high, right? The high that closed the bow. And we didn't reach 50%. So now this area becomes unmitigated, and most likely we're going to see a comeback to this area. So that's what we're seeing right now. We almost got back into this area. But also we are hitting this 50%, which is this bigger area, right? This is the area that price is coming back to. We had our swing high, swing low, and we broke. So now this is the range we are trading in. We are trading in this range, and price can do whatever he wants in this range. And it's still going to be bullish until it breaks this low, as far as 4-hour concerns. So if you were buying all of this in here, that was wrong. The order flow shifted bearish here, right? So where is going? Well, it's going to 50% to mitigate this area, number one. And also, there is unmitigated area below, right inside this bigger area. So what is price going to do? Price is going to go and grab this imbalance here that's sitting right below these equal lows and right at 50% of unmitigated area. This is what Enigma is. This is what they don't teach you in school. Don't teach you in those private FX groups. So anyway, Nasdaq on 4-hour is still bullish until we break below this low. And see, look at this. This area over here is unmitigated, right? We had a high, we had a low, we had a high. This area has never been mitigated. So what could happen here? We could break, close below the previous low, and trade back higher for a retracement, and then trade back lower, and starting a bearish trend. If we can just bounce here, never break this low, that's bullish. If we can break this high, we're still gonna go up. But what we can do, we can just bounce here, come back up, go back down. The price can do anything in this range, and it's still gonna be bullish until it breaks this low. Burn this into your brain, that this low that created a high, this low didn't create the high, created the high on the lower time frames in this range. So this low is gonna be the one that created a new high, right? This is intermediate highs and lows. Intermediate high, intermediate low, intermediate high, intermediate low, intermediate high, break of intermediate low. What do we expect now? We expect price to go back and test at least 50% of this previous area it broke out from. So now we can enter short, right? We can enter short here and take it all the way down to 50%. This could be a target. This could be a target. We see these equal lows, right? All of this is equal lows here. And then there is an imbalance here. There is an imbalance, an FVG, that's sitting right on 50% of the unmitigated area. And we take this short from here to here. So now we need to watch. Is it gonna bounce here or not? But the trade is done. Short. So let's zoom in into this high over here. There is a 15-minute high. So we were trading higher. We broke the previous high. We closed above it. So now, the trend is bullish. So what we want to see? We want to see a reversal for a retracement into the 50% of the previous area. There is a high established, then there is a low established, right? This low broke the high, made a new higher high. So this low is protected low, and if we break this low, right? If we break this low, we want to anticipate retracement to the 50% of this whole area here. And you can see we get a top over here, and it goes lower. So, but you might say, well, why didn't you count these wicks? Well, the wicks are manipulation. This was really manipulation, so we don't count wicks. And I'm sure if you can draw this up to the wick, it's still maybe going to hit here. But I like a more conservative approach, and what I like to draw is like avoid these wicks, and you can still incorporate these wicks, because this is not really manipulation. This is like a push higher, and this was a real manipulation for the downside. So for the For the downside, we want to ignore the up wicks, and for the upside, we want to ignore the down wicks. Price comes back into the 50%, trades lower. Amazing short, right? Short to where? Well, somewhere here in this structure. I don't know, you can keep holding it until you see the reversal, right? See, there is the reversal. Down, up, down, up, down. Enter trade long, but look how shallow it is. This is why I don't like to trade in the opposite direction of the trend, because it just reversed, right? Put in high, put in low, higher high, boom, reversed. So we really want to trade with the trend only. So after we see the bearish reversal, we get our trade over here and we keep holding it until some objective, until the target on the deviations, or until you just made a lot of money. I don't know. You can keep holding it and keep trailing your stops above the last high that created the low. See, just like here, look. Low established, intermediate high, intermediate low, intermediate high, low broken. So this high broke this low. So this high becomes protected. Look, the price comes up. Doesn't come up all the way up here. There's a bunch of imbalances here, right? Comes up to here, to this imbalance. Taps lower, go. Game over. Keep in mind this area here. See how we drop? This is unmitigated area. This thing here is unmitigated area, and the price, we want to anticipate the price coming back into this area. So that was 15-minute chart. Here's the 1-hour chart. Here's that high, right? There is that 50% tap. Price comes all the way down here. We have that unmitigated area that I point out. We ignore the wicks, and even if you get the wicks, you're still gonna get a tap, but we want to ignore the wicks. We get from this high to this low. This is unmitigated. We broke that, and now we want to anticipate a retracement back into this area. So keep in mind, we still haven't reached, right? We still haven't reached the unmitigated area below the 50%. Because in a bullish trend, we want to see a retracement at least to that 50%. So we bounced here. So now, because of the order flow is bearish on the higher time frame, after we break all of these lows here, right? These intermediate, it's bearish. We want to anticipate retracement back where? To unmitigated area or the previous area, right? I mean, there's this big previous area here, you know, but most often it will come back all the way to unmitigated area. And if this wasn't mitigated here, see how it got mitigated, right? Get 50% tap and down. This is mitigated area. And this is unmitigated area here. So what happens? Price comes up, taps here, all the way down. Look at this. All the way down, comes back all the way up. And now gives us a nice pattern here, right? Here's what it looks like on the 3-minute, right? We zoomed in all the way to 3-minute. So this area over here, I'm going to zoom in. Boom. There's that 50% that we are tapping. There's this whatever distribution chop that's happening here. But we want to see which low established the new high. So as you can see here, there's a low. Didn't close above the high, no. Go down, chop, chop, chop. This low broke the high, closed above the high. This hasn't closed. Nothing closed above this high. So this low is not important. So this low is important because it broke the high. So if we come down below this low, and you can see, look, it didn't close, so you don't have to take trade there. It didn't close. It came back. This would be amazing short, but again, we don't want to short until we see a close below the last low that made a high. So now that we see this close right over here, right? It came down all the way here, breaking this. We see that close. We anticipate retracement, but because this area is already mitigated, you see with this, we want to anticipate a 50% retracement to this area, the last one that sent price lower, breaking the structure. So we go, get a tap into the area, and I'm sure there is on lower time frame, even 1 minute or 10 seconds, whatever, you can see the same pattern, right? Broke down, comes back, goes low. It's the same pattern over and over and over again. See, unmitigated area, taps into it, lower, opens up. Look, this was at the end of the day. There's a 6 o'clock. 4 o'clock, opens up at 6, way lower. Look at that. So really, I want to focus your attention back to this. And this is what you want to be looking for in your charts. You want to identify high time frame trend, then anticipate these reversals at key points, at key PD arrays, and most importantly, at least at 50% of the previous area. So now I encourage you to go back test this strategy, to go look at your charts, to go tape read, because once you see it, you can't unsee it. And you will never gain confidence in your trading model, in your trading style, in your trading strategy. You will never gain confidence until you do it yourself, until you see it over and over and over in front of you live on the charts. There's the only way to learn this. There is no guru out there that you can pay your money to shortcut the learning experience. You have to see it with your own eyes. And it looks easy, it looks simple, but once you get into those nuances and different days in a market, different market profiles, and when there's a lot of volatility, there's a lot of volume, this all gonna look slightly different. There's gonna be different tricks that price action will pull out. But your job is to go in a chart and observe the price action every single day and understand that you can trade anything. It works all the time like clockwork everywhere. Any time frame, any asset, anything. If it's trading, it moves this way. And your job as a trader is to get on the right side of the market, capture a portion of the move, and get out. And on to the next setup. And in this video, I gave you some rules for the mechanical strategy, but really there's 3 levels of trading. First, you have mechanical rules. You just enter on this when the checklist happens. Then you have subjective rules, where you can, have more stuff and more built up on that strategy. And, sometimes, you can objectively identify the trend, and when your trading model says buy, maybe you don't buy because it's against the trend. So that's like subjective trading. And then the pinnacle, the mastery of trading is trading with intuition. That's where you just get in the zone, you open the charts, you just totally zoned in and in sync with order flow. You can buy, sell, buy, sell, buy, sell, and you pick the tops, you pick the bottoms, and you look like a genius. So that's the pinnacle, that's the mastery. Start with the mechanical trading. Start with this simple strategy, okay? And then once you see a lot of the price action happening over and over and over again, you will learn to adapt to the market flow. You will learn to adapt to the structure, to the certain characteristics of the price action. And the rabbit hole goes deep. But you don't need to know all the intricacies of the market. Start with this, go back test this, and 1 to 2 trades a day. You don't have to be scalping every single move. Try it out, okay? Try it out and see if it works, because you're only going to know if you backtest. So with that being said, I hope this video helped you. Make sure if you have any questions, just comment below, reach out to me on Twitter. Don't try to send me DMs because they flooded, but you can leave comments under my posts, and I usually reply to those if you have any questions. But the most of the questions you're going to get answered by watching the charts and by trying to trade with this psychology and with this logic. That's the only really way to learn this, is to keep trading it and keep seeing it over and over and over again. That's number 1. And number 2, I would highly encourage you to Also, check out Dexter on Twitter and his YouTube channel. His YouTube channel is on Spanish, but I watched it with subtitles and it was totally worth it if you want to dive in deeper into the standard deviations. And as far as market structure goes, if you want to understand more of the market structure and intricacies and nuances of the price action, how it moves on different days, I highly encourage you to go watch Dave Teaches FX on YouTube, his masterclass playlist. Really, I think that one of the best things that ever happened to the trading community. He puts it out all out there, and you don't have to pay him. You don't have to join his Discord community, and that's how it's supposed to be. It's all free out there. Go get it and use it. If you want further help, you can join his community, but he doesn't really care, right? Very genuine guy. Really impressed by his thinking and logical skills. It just, the logic is undeniable. I'm truly blown away, and like I said, if you want to learn more, check out his YouTube channel. But with that being said, guys, thank you so much for watching. If you found this video helpful, consider sharing it with fellow traders, investors, I don't know, your mom, and until the next one, stay safe.